My name is Michael Guyette, publisher of the Lead Lag Report. Joining me for there is Jim O'Shaughnessy. Jim, you've been around for a long time, but for those who are not familiar with who you are, introduce yourself. What's your background? How did you get involved in markets? How many companies have you built? And what are you doing now?
Wow. Okay. That'll take up the whole hour, Michael.
I want to make my life easier. This is about making my life easier to just have the
So thank you for having me. I'm delighted to be here. So I started life in asset management when I was in my 20s. Started a company called O'Shaughnessy Capital Management, which was essentially aimed at high net worth individuals. And then we pivoted to mutual funds and more public access using quantitative strategies that I'm probably best known for my book, What Works on Wall Street, which is now in its 4th edition, which outlines all of these strategies for the do-it-yourselfers out there. You can buy the book and you don't really need to hire me. We pivoted O'Shaughnessy Capital to a company called Netfolio, which was essentially the first online investment advisor. Actually got a patent, which when you read it today seems pretty scary. It goes along the lines of that we had a patent on the origination and distribution of investment advice and fulfillment over a worldwide computer network. Good luck enforcing that one.
So I guess we all owe you a lot of money.
No, you don't. I could never bring myself to be a patent troll, but that was actually done more for marketing purposes than anything else. I had the great for learning, bad for ego situation of launching that near the end of the dot-com bubble, and then got acquired by Bear Stearns, where I spent several years as the head of their systematic quantitative equity investments, only to leave on good terms with my friends there to form O'Shaughnessy Asset Management, which is probably what most people know me from. That company was acquired by Franklin Templeton at the end of 2021 because of our Canvas program, which was a much better, because it actually worked, version of Netfolio, which allows for custom indexing and portfolio creation, very specific to the end user. And now I am the founder and head of a company called O'Shaughnessy Ventures, which you can find on the web at osv.llc.
Okay, so first I want to go to the book, What Works on Wall Street. It seems like what's worked really since zero interest rate policy and ZIRP is one thing and one thing only, large cap passive, right? I mean, a lot of hedge funds have obviously had a hard time generating alpha. It's been hard to get any sort of real persistent factor momentum, I'd argue, outside of a growth tilt. Has anything changed in the last decade plus relative to when you first put that book out and all the research behind it?
Obviously, the zero interest rate environment was new, and you would be able, however, to look at other periods of speculation to get a pretty good sense for what might happen. Because essentially what these models really are directionally oriented. It's not this particular factor is going to work all of the time. One of the things when you go through the book, you see factors and groups of factors that we use in composites come in and out of favor. And in fact, one of the examples that I gave in a talk at Google was you're really treading on dangerous ground when you look at just a really limited period of time. So for the example I gave at the talk was, if you were looking at stocks that had the best growth in sales gains over a 5-year period, it really depended which 5-year period you were looking at, right? So the example I gave showed that the stocks with the best 5-year growth in revenue or sales soared. They killed the S&P, they killed the benchmarks, they killed everything. But then the trick was that was at the height of the 1960s speculative bull market. And then when we looked at it over the fullness of time, we saw that that particular strategy barely beat T-bills. So one of the first things that we always advise people is to look as best they can at as long a return stream as possible. because we're temporal creatures and we really oftentimes only focus on what's been happening recently. And that can lead you down a lot of dangerous blind alleys. What you want to do is look at the underlying strategy, be it buying high growth stocks or buying value stocks or microcaps, and then look at it over as long a period as you possibly can. This allows you to do two things that a shorter term focus doesn't let you do. The first thing is you're going to see that in different market environments, things that might look really compelling right now, or conversely, really, really awful right now, when investigated over a, say, 40 or 40 plus year time period, have other periods where they have done either very poorly or very well. What you want to do is find those strategies that have the most consistency, i.e., how often in the base rate overall rolling, 3, 5, 7, 10-year periods did they do better than their benchmark. But the other information you're going to get, which I think is vital to investors because you tend to be optimistic when you're embracing a new strategy or a stock, is to look at the drawdowns. People forget that there's a reason for the equity risk premium, which is the differential of what you get by investing in equities versus bonds. And the reason is there's a lot of volatility. So being aware of what kind of the worst case scenarios can be is going to give you a much better understanding. And really, it's going to help you decide, is this right for me? Because one of the things that I've advocated all my career is it's not that you have to embrace my way of investing. What you need to do if you want to succeed over time is to find a process, not a hit and miss, but a process that you as an investor feel that you can stick with. That's kind of the entire game.
I often say that your ability to stick to a strategy matters more than the strategy itself. Because, that's not to say a strategy doesn't matter, but the stick-to-itiveness is the critical part of it. It's like we all know how to lose weight, right? But yet, despite us knowing it, it's sticking to it. That's the critical dynamic. There's a lot that you said there which resonates very well with me. The idea that there's cycles in factors, I think, is missed by a lot of people. And it's missed by a lot of people because of exactly what you alluded to, which is we tend to live in the small sample, right? Everyone's basing decisions off of recency bias. And that becomes really challenging when you're trying to build an asset management business, as you know, especially when you're mark to market, as you mentioned with the mutual funds that you've launched, to get people to look beyond, what could be a 2-3 year period of relative underperformance, despite the long-term showing that what that strategy does actually has real merit.
Yeah. And, it's kind of part of our human OS. It's got a lot of bugs in it. And one of the things is that we tend to look at studies that cover large data samples. And then we think that a small sample, as you mentioned, conforms to the law of large numbers. It does not. As a matter of fact, they've demonstrated time and again that if you see some really anomalous outcome, say, for example, if there's two hospitals, one's a rural hospital where maybe 10 women a night give birth, and the other is a bustling hospital in New York City where there's literally hundreds in that particular complex. And you ask people, which hospital do you think last night 9 girls and only 1 boy were born? What hospital do you think is the most likely to have had that happen? A lot of people say the large hospital because, they're thinking, oh, there's more happening there. I could see where that would be anomalous. No, it's exactly the reverse. The strangest outcomes come from small sample sizes. And it's something that's really not intuitive. And so one of the things you definitely want to follow along with is the data that you want to focus on is very long term. But as you mentioned, factors, strategies, everything having to do with investing really does have to do with, cyclicality coming in and out of favor. And the one thing that you can really rely on, if you can figure out how to do it, is human nature doesn't change. And, I often say that the 4 horsemen of the investment apocalypse are fear, greed, hope, and ignorance. And if you think about those four, only one, ignorance, is not an emotion. Fear, greed, and hope have wiped out more portfolio value than virtually any other kind of mistake that you make when investing. And again, it comes back to our temporal nature. We live in the here and now, and it's very difficult to extract yourself from it. I have said in the past that, great investors live in past, present, future. All of these time streams make up their now. And your point about the ability to stick to a strategy really resonates with me. I was interviewed as I was retiring from O'Shaughnessy Asset Management to launch O'Shaughnessy Ventures. And the journalist asked me, well, what are you proudest of over your career? And honestly, the answer I gave him was, I am most proud of the fact that I never overrode one of our models, no matter how badly, how emotional I was. And that was hard. We had, after the financial crisis, we had a consultant come out and talk to us. And he told us that more than 60% of quantitative investors overrode their models. And what made them do that? Fear and, emotional reactions to what was happening during the financial crisis. So being able to conquer those, that's like a majority of the game. But let me stress again, I'm not saying it has to be my way. You've got to find a way that works for you and that you can stick with. And there's a variety of things that you can do there, right? You can index, you can be a quant, you can invest in themes. What resonates with you and what you can stick with, that's the important part of getting good results over the long term.
Yeah. And even going back to that point about you need to have as much of a sample size to see the potential size of a drawdown. Even that's not a guarantee either, right? Because there's always that saying that your largest drawdown is yet to come. And so much of the industry, the business side of investing and investing itself, but the two are intertwined, obviously, is just a function of timing and luck. So you talk about Netfolio and you were right toward the end of the bubble. I mean, had you known it was the end of the bubble, you probably wouldn't have launched, at least at that point in time, but nobody knew except with hindsight.
Yeah, that's another thing that feeds a lot of the biases we have. Our memories are really interesting things. They tend to update themselves to whatever we currently believe. And that might be hard to believe, but I've kept journals, handwritten journals, since I was 18 years old. And they are a treasure trove of being called a liar in my own handwriting. And as you go back and see what you actually wrote and what you actually thought at the time, you're going to be surprised by how often you'll say to yourself, I can't believe it. I would have sworn on a stack of Bibles in an open court that I didn't believe that then, but there it is in your own handwriting. So what happens is something like the .com collapse happens, and then everybody fills their memory retroactively with the idea, oh, of course I called that. Of course I saw that coming. No, you didn't. You think you did. And I'm putting myself in here too for all our listeners. I'm not immune. If you're running human OS, that's just part of the way it works. So kind of forcing yourself into this idea of getting a process that you can duplicate, that makes sense, but most importantly, that you can stick with, that's what's going to be very helpful to you in trying to do the best you can with your equity investments.
There's something you said, which I agree with, but I'm curious to hear sort of your thoughts on this aspect of the way markets work now. Human behavior doesn't change, but structures do change, right? So now you've got zero DTE, you've got zero commissions, you've got what I call structural insanity with this auto bid that happens with 401ks going to large cap Vanguard type of strategies, funds, right? That are, you can argue, maybe putting an artificial floor under large caps while everything else diverges, as we've seen really since 2014, I'd argue. Do you think any of that changes the calculus around the idea that markets don't change because it's about human behavior as things have just gotten more mechanized?
Yeah, I mean, that's a common question and interesting to think about. Josh Brown of Ritholtz had a piece called The Forever Bid. And I think if I recall it correctly, he was writing about what you just mentioned, the automated investments into 401ks, and most of those are going into indexes of some type. There's always going to be innovation, always. And if you know your market history, what you see is a repeat of exactly the same kind of behavior on behalf of the human investors of that era. So a couple of examples. When radio first came out, imagine it like the innovations of today that we're marveling at. They were like blown away by radio. And so what did investors do? They bid RCA up to levels that it would never be able to regain after they bid it all the way to the moon. But that's true of like every kind of cool new thing that you're hearing about, reading about, seeing. So, talking pictures, movies used to be silent, right? And when Warner Brothers announced that they were going to be producing and shipping only talking movies, their stock went up something like 400% in like the 1920s. And this just repeats. And, in the 60s, conglomerates were the big thing, and technology in the late 50s and early 60s when, Oppenheimer's popular right now. Well, there was a whole trend of buying atomic this and atomic that after that happened. And what you see is industries change, players change, the names of the companies change. It's like the joke that you often see when, Long Island Iced Tea changes its name to longislandicedtea.com. Or I saw some meme earlier this week where they would be changing their name to Long Island Tea Superconducting Company. And that's just playing on the way we process things as humans. So yeah, changes happen. And sometimes you've got to try to figure out, is that structural change going to materially change the way that we decide which stocks to buy and sell? Sometimes yes, sometimes no. That's why you want to be able to do continual research. I'll give you an example. The first thing I wrote for a professional publication, I wrote for Barron's in the early 1990s, and it was on the strategy popular then that was called Dogs of the Dow. Very simple strategy. You once a year sort the 30 stocks of the Dow Jones Industrial Average by dividend yield. You buy the top 10, you hold them a year, and then you redo that process. Well, I had actually recreated the modern 30 stock Dow back to when it began, when the late 1920s. A lot of people don't know that when you're seeing a quote on the Dow Jones Industrial Average from, say, 1911, it's not the modern 30 stock Dow. It is a much different index. Anyway, so did the research, published it. The results were quite extraordinary. It did very well. But then over time, things changed. They stopped putting kind of classic industrial companies that often looked at high dividends as a great feature for their investors into the Dow, and started putting a lot more tech companies, a lot of other stocks where dividends were not emphasized at all. So one of the things that we did with our ongoing research was, well, what's another way that the companies can get money to their investors? Well, buying back stock was a way that a lot of companies decided to use. So we augmented that particular strategy by including not dividend yield, but what we call shareholder yield. That's dividend yield plus buyback. So yeah, you definitely want to pay attention to structural changes in the market, like changes in an index, changes in a particular asset class. But keep in mind that every time you feel like, oh, this is going to change everything, it very rarely does, because the thing it doesn't change is us.
Speaking about dividends and the construction of the Dow back then, I think also people don't realize that the Dow Jones Industrial Average, just like the S&P, just like the NASDAQ, are not total return, right? So I think his name was Meyer Statman, had done a study a while back estimating that if you were to have reinvested all the dividends from the Dow back into the Dow going back to 1896, the Dow level would be like 1.7 million. right? With dividends reinvested. It's always amazing me just talk about human behavior, how people underestimate the impact of that compounding aspect of yield.
Absolutely. And actually, the S&P 500 is a total return index. You can look at it without the dividends reinvested, but you're absolutely correct that the Dow never included the reinvestment of dividends. I used to actually give that as a task when we were looking at interns and people to hire. I would say, the Dow is a price weighted index that does not reinvest the dividends, the S&P 500 or its proxy. A lot of people don't know that either. When you're looking at S&P 500 returns from anywhere prior to, I think it's the late 1950s, you're not looking at the S&P 500. You're looking at a proxy for it, which includes considerably fewer stocks, but very close to, it acts as a good proxy. And I'd say, okay, so your task is tell me what the Dow would be trading at today if it reinvested its dividends. And I wasn't looking for the real answer. I was really trying to see how that candidate thought. And, the general tenor was actually people had a really hard time trying to figure it out. The few people who did a really good job just asked a lot of questions. And this kind of leads into another thing that is really helpful is curiosity. If you're curious and you start looking things up, you find a lot of information that potentially is going to give you an edge in your learning and in your research and in your ability to continually improve whatever methodology you happen to use in investing. So, by the way, it's a staggering number. I don't have it in front of me, but like when I would give that test, and let's say the Dow is at 10,000, the actual answer, if you reinvested the dividends, was something like 66,000. And I loved that particular exercise because it also brilliantly illustrated the power of compounding. And, if you only want to understand a few things about why investing over long periods of time is a great way to take care of your retirement or your kids' education, whatnot, it is that absolute power of compounding. And, dividend reinvestment being one of the ways that you do that. The other thing I would say is there's all sorts of really interesting history in indexes like the popular Dow. I mean, I'm amazed that the Dow is still popular. It just shows how, it's Lindy and it's been around for so long that people keep referring to it. But, I think it was 1939 when IBM, which had been in the Dow, was kicked out in favor of AT&T. That one change dramatically impacted the returns on the Dow because IBM, with tech in the ascendancy, went on to go up 10x over the ensuing period before they put it back in, whereas AT&T just doubled. And so, it's really cool when you see God, it's just a change of one stock and, our collective view of what markets would have looked like would have been materially different. So those are interesting and fun things to think about as well, but they can also be used to remind you that you've got to really think long term. And that's hard to do. If you could train yourself to do that and look at evidence, get to a strategy and a process that works for you, you're going to be ahead of 98% of all the investors out there.
Yeah, I shared at the top of the nest. I was just doing a quick Google search. It was Myers Salmon. So there's a headline from Wall Street Journal in 2012 saying if you like Dow 13,000, try 1.339 million, which is, which goes back to the dividend reinvestment point. Let me reset the room for the remaining minutes here. Please make sure you follow Jim O'Shaughnessy. If you want to come up and ask questions, click that bottom left mic request button. And as always, this will be a podcast under Lead Lag Live.
Yeah, great question. Momentum is the factor that drives academic theorists the most crazy because there is no underlying economic and or financial reason for why momentum should work. And yet all of the empirical studies, if you get the fourth edition of What Works on Wall Street, you will see that momentum works really well over very long periods of time. For the fourth edition, we actually got access to the CRISP database. That's the Center for Research and Security Prices, maintained by the University of Chicago, that goes all the way back to the late 1920s. And what we found was buying stocks with excellent momentum was a really good strategy over most, I think, rolling 5-year periods. Whereas buying stocks with the worst momentum, really a horrible strategy. Why does it work? I think that it has to do with social contagion and mimetic behavior in humans. So we see something that is zipping along and it gains our interest, right? We're like, wonder why that's happening. And the more that happens, the more self-fulfilling it becomes, right? We had periods where momentum has just absolutely ruled all of the other strategies. Now, we did do a deep dive into momentum. And one of the things that we found that could be useful to listeners is that following a severe bear market, and I think, defined a severe bear market as a stem to stern loss of greater than 40%. After experiencing a severe bear market, momentum inverts. And if you bought the stocks with the best momentum, you actually got the worst results. Whereas if you bought the stocks with the worst momentum following that horrible bear market, you got the best results. Now, if you think about that for a minute, it makes some sense, right? Because a lot of babies got thrown out with the bathwater, and some of those were perfectly good babies. And so when you see investors coming in and kind of cherry picking after a severe bear market, they're buying stocks that got hit very hard, but nevertheless had what the investor viewed as excellent prospects or excellent financials, etc. So momentum is one of the most studied because you can also look at non-equity alternatives. So for example, Mandelbrot looked at cotton prices on a daily basis and found that there was strong momentum in cotton prices. And others have looked at a variety of other asset classes, also seeing strong momentum performance. Now, it, as I mentioned, does not work all the time. And when it isn't working, it really isn't working. So momentum is also accompanied by a tremendous amount of severe volatility. And that gets us back to human behavior, right? So you start when momentum's working, you love it. You're like, this is the best thing in the world. And then all of a sudden you open your portfolio and it's down, 35%. What does the average person do? Even a professional, mind you. I'm not trying to say that this is something that, some great professional class of asset managers can weather because, it's very hard to. They often sell emotionally because they were not ready for that kind of volatility. So finally, Mandelbrot in his book, The Misbehavior of Markets, by the way, I recommend that book very highly for investors who are really lovers of going down the rabbit hole. He does an excellent job of explaining why markets probably are not nearly as efficient as many theorists believe, even though they are functionally efficient at levels of price discovery and the inability to arbitrage like we used to be able to in the past has been arbed away. But I'll leave you with one of his hypotheses from the book. And that is essentially Mandelbrot posits that markets have memory and that is one of the other reasons why momentum works. So it's, we see momentum elsewhere in society, in endeavors, etc. And so I guess the final thing I'll say about momentum is it takes advantage of the wisdom of crowds. And I think the thing we need to keep in mind is that crowds are wise only when they meet specific criteria. And the most important of those criteria is that they have to have heterogeneous reasons for doing what they're doing. That's a fancy word for saying different reasons. So if I'm buying Apple and you're selling it to me, if my reason makes sense, like maybe I'm buying Apple because I'm putting together a college fund for my grandkids, and maybe you're selling Apple because you want to buy a new house. That makes a lot of sense. And as long as heterogeneous different reasons are present and the crowd is large enough, you're going to see momentum working very well. Momentum fails when bubbles or crashes are dominating. What happens then is that investors' ideas move from heterogeneous to homogeneity. In other words, everybody's thinking the same thing at the same time. You see that in market crashes like the great financial crisis, everybody thinking the same thing at the same time. That creates what I call an information cascade. And when that happens, it is almost impossible to be a classic contrarian. We are social creatures. And when everybody's thinking the same thing at the same time and acting on it, it is virtually impossible. And unless you're like Odysseus and tie yourself to the mast to avoid the siren's call, you fall into line. That's why you see the kind of janky 5-year periods where momentum absolutely gets crushed, often followed by periods where momentum goes on to soar when we return to a more heterogeneous investor environment. So we always were orienting our research around long-term results. So we haven't done as much work in trying to time factors. We did take a look at a lot of models in timing of factors. And I can just tell you, we ended up equal weighting them in our composite because there was no underlying empirical evidence that we, at least in our limited research, figured out a way to time factors. Well, obviously you've done that research and, if that's what you're finding, that's excellent. We did look at longer term momentum and we did find that at the 60-month mark, it was reversal. In other words, the stocks that had the worst 60-month return, the decile with the worst 60-month return tended to mean revert and do better, whereas the stocks with the best 60-month momentum tend to mean revert and do worse. I can't comment on the 5-day one because we didn't do that kind of research. But yeah, there's all sorts of different ways to slice and dice momentum. I guess I'll leave you with one thing that we did find and did incorporate into our composite looking at momentum. And that was we put a volatility using standard deviation of return in there, emphasizing lower volatility stocks. We found much more consistency and a smoother pattern with that paired with momentum.
I would add real quick on the entire momentum discussion there. I always reference this study that was done it was like early 2000. The title of it was Why Rejection Hurts. And it had nothing to do with markets. But basically, the study was you had a bunch of people come in. They were told to sit down and told they were going to be playing a game kind of like Pong with 2 other players online. So this ball would go back and forth. And the person sitting there at the computer, they've got all these things connected to the brain to monitor activity. And the person wasn't actually playing with other people. It was an algorithm, right?
Yeah.
So the ball is going back and forth. The person's immediately playing with 2 other people through this computer game. And then suddenly the ball is only being thrown to the 2 other, in quotes, people. So the person now is being left out. And they monitored brain activity in that moment of being left out, in that rejection. And the part of the brain, as I recall, that gets activated it's the anterior cingulate cortex, which is the part of the brain that registers physical pain. So the idea there, the implication of the study was that when you have rejection, when you're not part of a crowd, when you're contrarian, right, your brain actually interprets it as physical pain. Now, there's some evolutionary reasoning behind that, right? Because you are much more likely to survive the woolly mammoth chasing the crowd if you're in the crowd than if you're by yourself. So I'd argue a lot of the momentum dynamics and factors, we're almost hardwired to be like the crowd, to chase with the crowd, to follow the recency bias, because history suggests that's actually the only way to survive physically.
Yeah, those are fascinating studies I have embarked on, looking into how many of them replicate. And many do, by the way. And it brings up a very good point. And that is, we have to remember that there is not this mythical separation as Descartes would have it between our mind and our body. The two are hand in hand, glove in glove. And literally your idea about it feeling like physical pain is a great manifestation of that. When we are rejected, when we are shunned, when we are disliked openly by members of what we thought were our tribe, that has profoundly negative effects on our ability to make rational, straightforward decisions. So that's an area where I think that people who really like to go down rabbit holes should do a lot of the research, because that gets me back to the emotional underpinnings of decision making. There's a great quote by Marcel Proust, the French author, which I'm paraphrasing it, goes along the lines of, "It is always thus in a moment of feeling that is destined not to last, we make our irrevocable choices." And that is a time sequencing problem. And the other thing about emotions that are really interesting is, because we feel them in real time, it's very difficult, unless we write it out and where we can refer to it back after the emotions have passed. It's very difficult to come up with a model for dealing with them other than like a quite severe one, like we did as quants, right? So, if you sold in disgust or bought, something everyone else was buying and then it crashed and burned on you, you might look back 6 months later and think, "Oh my God, what was I thinking?" Well, the fact is you probably weren't thinking. The fact is you were probably making a very emotionally based decision. And once those emotion and those molecules of emotion that neuropeptides carry through our entire body have washed out of your system, logic returns. And so you look back, I'm sure many of us, especially those of us who keep investment journals, have seen this time and time again. When you look back devoid of the emotions, you can put a much more rational framework around it. But emotions are incredibly powerful things. And to your point about evolution, they are incredibly powerful things because they kind of advanced us as a species. Fight or flee, right? That's kind of the base code of our evolutionary heritage. And it's still playing with our ability to successfully invest for the long term today.
I want to pivot a little bit to O'Shaughnessy Ventures and what you're doing on that side of things. I love the first thing you see on the website is unleash your infinite potential. And I think that's an interesting phrase in an environment where, you can argue that younger people maybe are not as, maybe I'm wrong with this, maybe not as ambitious. There's so many luxuries in terms of technology that hunger may not be as strong as it was in generations of old. Talk about what you're doing with that side of the world and some of the more interesting things you've observed just, almost generationally from people you're engaging with.
Sure. So I think the future needs a rewrite. I'm a huge science fiction nerd and love it, and have been troubled by the fact that almost all of it has been dystopia followed by dystopia. And a lot of people aren't aware that it wasn't always like that. When you think about the world's fairs that we put on here in America and elsewhere in the world, there was a palpable optimism about what the future held. And for a variety of reasons, that got seriously dashed, right? Stagflation in the 70s, a series of wars that we probably shouldn't have been fighting, inflation, etc., led to a general vibe that was pretty negative about what the future held for us. And I think that you've got to always try to balance the positives and the negatives. But when anything kind of gets uniquely of just all saying the same thing, negativity, I think that needs to be corrected. I think that I cannot tell you how happy I am to be alive at this moment in time. With all of the advances made in technology, artificial intelligence, the ability to fold proteins that leads to actionable new medicines and whatnot, and then marrying that with a worldwide platform that's really just kind of coming of age now because some of the tools to use it much more efficiently are also being invented right now. So I think that we've never had a period in history where we had this much leverage. And I'm very excited about that. And additionally, we also have, for the first time in history, your digital zip code being more important than your physical one, right? So in the past, even the relatively recent past, you could be born, live and die a genius and you didn't know it and nobody around you knew it because you might have been born elsewhere where you didn't have access to the kind of education or the kind of tools or people that you could unlock that genius. And one of the things that I noticed happening as the internet was maturing, Matt Clifford, who runs Entrepreneur First, a portfolio company of O'Shaughnessy Ventures, we're investors there, had a great term for it, which is the internet is the greatest variance amplifier in human history. And what did he mean by that? He meant that if you've got a smartphone and you can connect to the internet, you have literally the world at your fingertips. You have the ability to do the kinds of research that would have cost hundreds of thousands, maybe millions of dollars in, call it 1955. And what you have more than that, though, is you have reach. You have the ability, you could be in Kuala Lumpur, or you could be in Bangalore, or you could be in, a rural town in Alabama. And all of that used to severely constrain what you could or could not do. Doesn't anymore. If you are doing something really cool, we can see that if you put it online. It's one of the reasons why we give scholarship to David Perel's Rite of Passage. We think that writing is getting more important, not less important, because you have the ability to reach all sorts of others who are not only interested in what you're doing, but might want to invest in it, might want to partner up with you. And so I think that given the tools coming online, we are living at a conjunction of having all these tools, having people with the ability to use them and share them, and then having people like us at O'Shaughnessy Ventures being able to not only see that, but fund it. So we have a fellowship program there where we give fellowships of $100,000 to people that we think are doing really interesting, very cool things. Some of those go to enterprises that may end up being commercializable. Others don't, right? We want to have them available to the full spectrum of the bright people out there. And so the idea of unleashing your infinite potential is exactly that. We really are now in an environment where that is something that you can work towards. You now have the tools, you now have the associations, you now have all of these things available to you. And it's really remarkable. I sometimes think, like, if I brought my iPhone back to 1970 Jim, I guess the closest he could have gotten was, oh, that's a communicator like they have on Star Trek, right? But the rest of it would have blown his mind. And so we were also, in addition to, being quite good at tool making and extending our reach, we also adapt very quickly. I keep old tech just to remind myself of where we were. And what happens is you kind of seamlessly think whatever the current tech is, well, we've always kind of had that. Well, no, we haven't. And so we're incredibly excited about all the advances being made across the spectrum. And so that's what the new company is devoted to.
Jim, for those who want to somehow get involved with you or track more your thoughts, where would you point them to?
You can apply to join our Discord. We originally used it to invite everyone who applied for a fellowship. We are now opening it. I will have our team at the handle of OS Ventures on Twitter put up how to do that. And we'll put it up on the other networks as well, like Instagram and LinkedIn, etc. That might be kind of the first step into finding like-minded people. Of course, you could always find me on Twitter, which I kind of use as my daily common thought diary. If you don't like GIFs and memes, though, you might want to keep me muted. And obviously, you can check us out at our website, which is OSV Oscar Sam Victor .LLC Larry Charlie.
Good place to wrap this space up. Again, this will be in podcast under Lead Lag Live. Everybody, please make sure you follow Jim. And Jim, real honor and pleasure to speak with you. Appreciate your time here.
Thanks for having me on, Michael. Really enjoyed it. And have a great day, everyone.